Steve, you tweeted this week that the market is pricing in a 2% cash rate in 2013. Can you tell us what's going on there?
I think what the market's looking at is the risk of a hard landing coming out of Europe, that impacting on China. We're seeing commodity prices falling already. So if you look at things like the Commodity Research Bureau Index of Commodity Prices, it's back to where it was in 2004. So we're seeing that disinflation coming from the weak world economy. And because of that, the market now is partly panicking and possibly overshooting in pricing at a 2% cash rate. But at the very least, we're going to be seeing downside risks to the economy, really low inflation coming through as these lower commodity prices filter into all the goods that we buy every day. And so the market's looking for quite aggressive rate cuts.
And what's your outlook for the dollar?
Well, because of the fall in commodity prices, the narrowing of the yield differential between us and the rest of the world as these rates come down, we just have to look at some of these bond yields, staggeringly low, below 3% for the 10-year bond. The 2-year bond's almost at 2%, just numbers that we've never seen before. That means that the yield advantage that a lot of investors have of putting their money in Australia is eroding. It's not catastrophic, but it's eroding. So that I would guess that by the end of the year, pinpointing forecast for the dollar is always a bit hazardous, but we're probably going to be near a 90, even a little below 90, if this slowdown in the global economy continues to unfold, if we see the cash rate being cut to the extent, even roughly to where the markets are pricing it. And because of that, the dollar could easily fall another 5, 7, 10%, something like that.
You're talking about the prospect of a disinflationary shock from commodities, but what does that mean for the resources boom?
I'm getting a little bit worried that we've got a lot of extra output. So we're getting a supply side response, not just here in Australia, but in parts of Central Asia, in Africa, in South America. Everybody has been revamping their mines, and we're seeing a supply side response to what were really high commodity prices. It's market forces at work. It's a good thing. However, that's occurring at exactly the time when we've got global demand cooling off, so that the use of these minerals and the mining output is actually starting to come off a little bit, or certainly not grow anyway. So you get this dilemma that you've got a higher supply of mining output at a time when demand is falling, and you don't have to be John Maynard Keynes to realise that you're going to get falling prices. That's the disinflation risk that's coming through from the weaker world economy and from the supply side response.
Thanks very much, Steve.
Thanks, Alan.